Hi, my name is Paul, and welcome to the 23rd episode of my monthly stock portfolio series, where I invest $100 of my own money each month into Canadian securities, and I do this series every month to track the ups and downs of investing so that I can show aspiring investors what to expect and what can be achieved by following a simple plan of regularly investing some of the excess money that's left over at the end of each month, even if that amount is $100 or less. In this month's episode, I'm going to be pointing out why the Morguard North American Residential REIT is the best and most undervalued residential REIT trading on the Toronto Stock Exchange. But before we get to that, we have earnings to go through from the portfolio's two largest holdings, and I want to show you how the portfolio performed during the month of October. Afterwards, you'll get to see exactly how I'm going to be investing this month's $100 and the dividends that were earned in the previous month. Now, before we get into the video, you should be aware that there is a link in the description box to the goals and rules that I've set out for investing within my monthly portfolio. But if you happen to be someone who prefers watching to reading, then you can also watch me go through everything in the first episode of the series. And a link to the playlist starting at episode 1 is also available in the description box of this video. With that, let's get into the news. First up, we had goeasy announcing that they'd increased their automotive revolving credit facility by an additional $175 million. And this just means that the company can access more debt to grow the business if needed. But last quarter, Jason Mullins, the CEO, stated that the company should not need to take on more debt, since the business was close to being able to fund all of its growth through earnings. However, in the press release associated with this new increase to the company's credit facility, Mullins said that this increase will provide the company with a greater capacity to fund growth plans. Now, this raises some questions as to the accuracy of the statements he previously made about not needing to take on debt to fund the growth. Though it should be noted that the company may just be looking to strengthen the revolver with this new move, or it could be that a new growth opportunity has presented itself, or it could be something else entirely. Thankfully, we'll likely be getting some answers in a few days, since goeasy plans to release their earnings results on the 7th, and their conference call will be held on the 8th of November. The next piece of news that came out last month was MTY's earnings, which I've already made a full video on, so I'll make the summary here pretty brief. Right off the bat, things were fairly mixed once you account for the previous acquisitions that made the corporate numbers look massively higher. Most notably, food processing, distribution, and retail numbers were not great, with the US segment's declines being due to a temporary loss of a key licensing agreement. On the other hand, the Canadian side saw slow growth due to grocers pushing customers towards their own labels and bundled deals, as well as consumer demand being split between high and low-end products, with the more middle cost range products receiving less interest. And it didn't sound like there was much that could be done about this, so we'll have to just wait for consumer demand to return. But in the meantime, management did announce that there will be some new products coming down the pipe in the coming quarters. As for the organic franchise growth, this portion of the business also experienced minimal growth in the 3% range. That said, we do have reason to believe that the numbers will be trending upwards, since the company's larger banners seem to be seeing a lot of demand and pushing growth, with Cold Stone Creamery and Wetzel's Pretzels being mentioned as standouts. Unfortunately, the company did fail to achieve their projection of positive net location openings this quarter, with the result being 5 net closures. This was a bit of a letdown, but it does seem inevitable that the company will achieve net openings at some point in the coming quarters, since there do appear to be tailwinds forming. Now, even though franchisees are struggling to obtain financing in this high interest rate environment, these economic factors are not preventing customers from turning up. Plus, the pandemic-related backlog on construction and inspection work that had been delaying new store openings is finally starting to clear up, which should see locations that have been in progress finally start completing in a timely manner. And according to the management, there are a lot of funded locations that are in the process of being completed. So, poor results and a positive outlook there, but that's the end of the mixed results. Everything else looked good. Segmented operating expenses after adjusting for the acquisitions either declined or grew slower or in line with the revenue growth, which means that there was organic margin expansion. Free cash flow per share for the quarter hit $1.77, thanks to the reduction of capital expenditures. And CapEx is expected to continue declining as MTY finishes up their obligatory builds pursuant to the completion of their recent acquisitions. As for the debt, the company paid down an additional $26 million worth in the quarter, which again shrunk the total projected interest owed. Plus, the interest rate swaps that the company entered into were mentioned in the call as having contributed to an average of $600,000 in interest expense savings per month so far. Now, we didn't get any buybacks this quarter because the management's attention is currently on getting the debt down to a more stable level. We also did not receive a dividend increase this quarter because MTY doesn't usually make their annual raise until Q4. But if you watched last month's episode, I went on about how we should expect a dividend raise. Well, that was a dumb mistake that I made and I was wrong. Though I do still think that we will be seeing a raise, it just won't be until next quarter, which again is when MTY usually raises their dividend. They didn't delay their dividend or anything like that. This was my screw up, and I don't plan on having another mistake this dumb for a while, but I do apologize for the misfire on that. Anyway, that was about all of the important stuff that came out of MTY's quarter, which all in all was decent, though I was expecting a little bit more going into it. Moving on, we have to go through the Morguard North American Residential REIT's third quarter results, and things started off pretty well. First, average monthly rents in both Canada and the US properties continued to increase, and Canadian occupancy ticked up to 98.9%. Unfortunately, the US occupancy declined by over 2%. Now, I was originally worried that this was a sign that the rapidly rising US rents were driving out tenants and that we should expect lower rents going forwards. But thankfully, this is only partly true. See, on the conference call, we received some additional context that explained this decline in occupancy as having to do with a greater amount of people moving in and out, as well as an increase in non-paying tenants being evicted. According to the management, most of the squatters had not been paying rent since the pandemic, and the REIT has finally made the decision to go forward with processing evictions, which has led to a negative impact on occupancy. That said, occupancy of non-paying tenants isn't really something that's desirable. Plus, the management mentioned that this should be a one-time dip and that they expect US occupancy to remain stable due to lower leasing activity in the winter months. So that wasn't really bad news, but we also learned that the high rents in the Sunbelt region have likely peaked, and the REIT's AMR in these regions is only expected to increase slightly before plateauing over the coming quarters as tenants renting at lower rates either renew or turn over at the higher stabilized levels. That said, on the Canadian side, rents are still exploding, especially in Ontario due to the provincial suppression of rent increases and a lack of housing supply. These two factors have seen Canadian average monthly rent on turnover grow by 21.6%. So there will likely be a lot of rental growth there over the coming years. Next, let's take a look at the funds from operations. And adjusting these numbers for anomalous gains or losses that can't be expected to reoccur, the diluted AFFO growth was about 13.8% over last year's third quarter. Unfortunately, costs were a bit higher this quarter due to the increased cost of labor, insurance, and taxes. But while these are factored into FFO, capital expenditures are not. And the CapEx this quarter did increase due to inflation's effect on renovation costs, as well as the expensive garage renovation project that is currently in the works. In addition to that, the management also confirmed that they will be undertaking another garage project, which will push the total 2023 CapEx to about the same level as last year. Though in Q1 and Q2, costs are expected to drop back down to more normal levels, which will need to be maintained if the company plans to keep both the dividend and buybacks going long term. Though they could alternatively increase FFO, sell a property, or reduce interest expenses by paying down debt. As you can see here, the interest expenses are currently hitting about $18 million per quarter, which when combined with the higher CapEx is basically eating up all of the FFO. So the buybacks and the dividends are coming right out of the company's cash pile at the moment. This is not ideal, and it will only be able to continue for a couple more quarters without the management either boosting profits, lowering costs, or finding an alternative way to finance the programs, since the cash pile is currently sitting at under $30 million. This might sound a bit scary, but the REIT has a lot of options at its fingertips to drum up cash. In fact, just completing the garage project and getting paying tenants into the recently unoccupied apartments would be more than enough to cover the cost of the dividend, which was just raised by 2 cents to 74 cents per year. Meanwhile, after doing some math comparing last quarter's report to this quarter's, it looks like the REIT repurchased 570,000 shares at an average price of $16.06. This means that in total, the amount of shares repurchased so far this year is basically breaking even with the dividend raise. So while shareholders are being paid more, there are less shares to pay out, such that it isn't actually costing the REIT any additional amount of money to permanently raise the dividend. Taking a look at the debt, we can see that there is no debt due to mature for the rest of the year. And according to the management, the debt coming due in 2024 isn't going to reach maturity until the latter half of the year, with one portion set to mature in July and another in December. So if the Fed can manage to get a hold of inflation and ends up lowering rates, the REIT might be able to dodge rolling its debt into some pretty ugly 5% plus interest rates. Now, that is a pretty massive if, but it does at the very least give the management some time and wiggle room to make an alternative plan. Personally, I'm hoping that they either end up deciding to sell a weaker performing or slightly older property, either at a loss or at a price where they can shelter some of the gains by utilizing a 1031 exchange to buy a cheaper property, while allocating the remaining funds towards buybacks and debt repayment. See, according to the management, many entities are highly leveraged on floating rate debt and will have to refinance or sell due to higher risk acquisitions made in prior years. So this could present some fire sale opportunities that would improve the REIT's portfolio in the US, especially if the REIT manages to sell off a property in Canada where buildings are relatively older but command higher prices. And on the conference call, the management did note that they are interested in potentially acquiring some quality buildings, but that they're also committed to doing buybacks. Last up, we have to look at the appraised value of the properties. And this quarter, they did increase moderately over Q2, but when we break these numbers down, it looks like while the Canadian property values did see an increase, the US property values decreased in US dollars. But because the US dollar performed better this quarter relative to the Canadian dollar, the total converted value of the REIT's properties did increase. But we will likely start seeing the values decline a bit going forwards, especially if rents peak and access to capital continues to be a challenge for prospective buyers. So, all in all, this was a pretty reasonable quarter, though some challenges may be ahead. Noting that the REIT's future does still look brighter than where things currently stand, and the management's history leaves me feeling pretty confident that they'll be able to continue making good decisions going forwards that will be accretive to the shareholders' value. And that concludes the news for the month. Aside from GoEasy's increased efforts to boost financial literacy, which will likely be a good thing, but there wasn't all too much worth going over without getting additional commentary from the management first. So with that, let's go through the portfolio's performance. And continuing on with September's trend, October was a horrifically bad month for the portfolio. Starting with the worst performer, the Morguard North American Residential REIT's shares started the month at $14.90 and plummeted 8.93%, ending the month at $13.56. And at one point towards the end of the month, the shares nearly dipped into the $12 range. Now, last month, I picked up 4 shares of the REIT for a total of $59.60. Plus, Morguard makes up the portfolio's largest position, so this move downwards really hurt the performance quite a bit. Thankfully, Morguard did pay out $5.58 in monthly dividends, and that did lighten the blow at least a little bit. Next up, we had MTY Food Group, whose shares started October at $56.12, but fell on earnings alongside other fears, ending the month at $53.56 for a price decline of 4.56%. Last month, I did purchase about 0.81 shares ahead of the earnings, which I'd expected to be very strong. So I ended up having to eat a bit of crow when the earnings were a bit underwhelming. But despite being dead wrong on that, I still thought that the earnings were reasonably positive. And I'm rarely ever looking to make short-term investments. So despite the misfire on my short-term prediction, I'm still in MTY for the long haul, and this month MTY did not pay out its quarterly dividend. Finally, last month's best performer was GoEasy, which was the one positive note within the portfolio. But I didn't buy any shares last month, so even though the shares appreciated in price by 8.5%, it won't affect my 1 month performance at all, though I did receive $1.56 in dividends from GoEasy's quarterly payout from the shares that I'd purchased several months ago. So, performance-wise, there is not going to be anything positive to mention. Even if we include the dividends that I received, my 1 month investment performance was negative 0.25%. And if we don't account for the dividends earned, it was negative 7%. Meanwhile, all of the benchmarks turned out positive performance results, and most of them received dividends to boot. So, after my portfolio's clear last place finish, the Global Value ETF was next, achieving a gain of 1%, and it was followed by the S&P 500, which grew close to 1.1%. Next was the Canadian All Cap ETF, which grew by 2.44%. And finally, the best performer for the month of October was the Canadian Large Cap ETF, which climbed 3.19%. However, with the dividends included, the performances were even more drastic, as you can see reflected in the black numbers within the percentage column. To conclude this month's performance segment, since the start of the series in January of 2022, up until the market's close on November 2nd, 2023, so far I've invested $2,259.21 of personally contributed capital and dividends. Now, the market price of the portfolio's holdings have dipped well below that and are now priced at $1,913.68, which is even lower than last month. And last month was worse than the month before it, so it's been kind of a rough patch to say the least. As of this recording, the current loss is over $345, or about 15.3%. Despite these losses, I'm still standing my ground. I haven't seen anything in the underlying businesses that justifies these declines, so I have no plans to cut my losses, as you'll see shortly. But let's first take a look at this graph, which shows performance net of contributed capital. My portfolio, represented by the green line hurtling towards a new minimum data threshold, is terribly underperforming everything, let alone my monthly goal of a 12% annualized rate of return, represented by the ever-increasing red line with stars. As you can clearly see, we're currently at the worst discrepancy in the portfolio's history, with the difference exceeding $520, requiring over a 27% increase to get back on track. Transitioning over to this graph, which shows the total portfolio value with contributed capital included, it's almost as if there's a barrier preventing my portfolio from finishing the month above the $2,000 mark. But I have reason to believe that these recent challenges, harsh as they may be, will eventually turn around, because the securities that I'm investing in have strong fundamentals and they're heavily discounted relative to their underlying value. In this segment, I'm going to center my focus specifically on Morguard, since MTY already received a similar segment in its dedicated quarterly video. Now, it's no secret that Canadian residential REITs have been getting hammered on fears regarding the real estate market and financing challenges within the higher interest rate environment. This is a graph showing Morguard and its direct residential REIT peers trading on the TSX, showing all of their share price fluctuations post-COVID. Now, I've chosen not to show the names of any of these trusts since I don't like to directly point out negative attributes of companies that I'm not invested in. It seems needlessly harsh, and my point should come across either way. Anyway, Morguard is the better performing of the two orange lines here, having seen its shares decline in price by 35% from its pre-COVID levels. That makes it the second most hard-hit residential REIT in the Canadian market. Now, you might be thinking, why not go for the one that's down almost 50%? Well, you wouldn't necessarily be completely on the wrong track. My research tells me that it seems to be trading pretty cheap relative to most of its peers. But it's not trading cheaply relative to Morguard. See, even though its share price has dropped more, the net value of its properties relative to the share price is nowhere near as discounted as Morguard's is, and neither are any of Morguard's other peers. Furthermore, Morguard is one of only 2 Canadian residential REITs allocating capital to locking in the discrepancy between share price and net asset value by utilizing share repurchases. Finally, I want to point out that Morguard's property portfolio is of higher quality than its peers, based on the higher levels of average monthly rent per apartment it's able to generate, also based on the younger average ages of its properties, which correlate with lower capital expenditures, and also the population growth projections set for the geographic regions in which its properties are located. Put simply, Morguard is the clear-cut, most discounted security of the heavily beaten-down Canadian residential REITs, despite having one of the strongest property portfolios and them having a quality management team that is actively working to bridge the gap between share price and net asset value. This is why I continue to buy MRG shares despite their declines month after month after month. Now, it's important to recognize when a security is discounted for good reasons and to address those reasons head on. But in Morguard's case, the minor uncertainties do not explain the incredible discount. And I intend to continue capitalizing on the fear that has plagued the industry by continuing to buy more shares. So for this month, my plans are to purchase 5 shares of the Morguard North American Residential REIT, and I'll put the remainder into fractional shares of MTY Food Group, which I believe is also unreasonably discounted. And I've already deposited this month's $100 into the Wealthsimple account, so let's get to investing. Okay, I'm here inside the account. It's Friday, November the 3rd, and I have $107.14 to invest. So we're going to start with Morguard. And I'm going to go with 5 shares of that. So we're going to buy these 5 shares, continue and confirm. Okay, and that leaves us $38.59, all of which we're going to be putting into a fractional buy of MTY Food Group. Okay, and then we're just going to buy that. Okay, I've just received an email confirming that I've successfully bought 5 shares of the Morguard North American Residential REIT for $13.71 each, in addition to 0.71 shares of MTY Food Group at a cost basis of $54.38 per whole share, leaving my portfolio with no cash left over after my orders have been filled. So, as of the market's close on Friday, November the 3rd, the portfolio holds 102 shares of the Morguard North American Residential REIT worth roughly $1,397, about 8.2 shares of MTY Food Group worth a little over $443, and the same 1.62 shares of GoEasy, which are now worth roughly $195. Now, getting into the dividends, in October, Morguard paid out $5.58, while GoEasy paid $1.56 for a combined $7.14. That's enough to buy this 12-pack of double-sized toilet paper rolls, and this is a very real expense that is now easily able to be covered thanks to the income generated by the portfolio. So even though we're a long way from affording financial freedom, we are making real progress. In fact, if we count up all of the dividends that the portfolio has earned since inception, it tallies up to $66.35, with over $49 flowing in year to date, nearly tripling the $17 earned over the year of 2022. In addition to that, next month we're projected to receive a new dividend record, totaling $7.69 from both Morguard's monthly payment and MTY's quarterly payment. Noting that, it's important to realize that after the November distribution, Morguard will be paying a higher dividend payout of 6.17 cents per share per month, as opposed to just 6 cents per share per month. So factoring in this raise, if we were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no changes were made, I would now expect to receive $89.95, which is a 7.64% increase from last month, and that increases the yield on contributed capital by 11 basis points to 3.91%. And that's going to wrap up this month's video. But before you go, remember this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.